Apologies for the little technical delay, but it's been sorted out. And thank you very much, boss in the office, for helping us out. So today is Federal Funds Rate News Day. And I just thought it fascinating what is taking place in the market. Now, federal funds, FOMC, if you look at Forex Factory, it's scheduled 8 times in a year. So what is taking place is unusual, but it does happen. And this news announcement is, I'm hoping it's going to turn out to be quite dramatic after what's happening across all the different markets. So I will take you through what I am talking about. This is pound versus the US dollar. And what I'm just highlighting is that sometimes you have unclear signals, and yet the market you're looking at is doing something distinct. So in this case, the market is trending up. So what do? You want to trade, of course, you want to find opportunities. But one thing that, I've kind of decided on myself, for myself, is if you have low probability entries, why take them? Okay, why put yourself in a situation where you have to manage through difficulties to exit out of trades that were low probability in the first place? And one of the reasons that makes us take low probability trades is that we just want to trade anything. But our goal is to make money. And if the market gives us the opportunities, is to consistently make money over a period of time. So one of the things for me is to eliminate low probability trades. And I'm going to be more and more strict with myself going forward. And one of the things you will notice that there's a lot more currencies, surprise, that I'm looking at. Typically, for a long time, I've just been focusing on a few indexes, which means, you take as many trades as you can in there. So here is my thoughts. Now, federal funds news rate is about 7 hours from now, right? So depending where you're at in the market, within 7 hours from now, 7.5 hours. Yes, 8 p.m. my time. So it will be 2 p.m. Sing, and 1 p.m. For guys on the West Coast, etc. The news will be announced, and I think the market is beginning to prep for it. So just one of the charts. This yellow block here is the open of the UK markets. Now, if you saw that with all of this that has taken place during the morning, are you going to buy that? Most likely not. You say to yourself, let me wait for the, I'm pausing. I was speaking to a trader this morning and I was saying, well, you can take any trade anyway. Just have to decide how to manage it, where to put your stops, how much to risk, etc. But if the goal is to try and find higher probability trades, then you really have to just sit back and wait for things to become clear. So low probability trade, if you're going to take that particular trade because you say, okay, I'm going to wait for the follow through. You don't get the follow through. Remember, all of this hasn't taken place. You get to the top of the morning trading range, Asian session trading range, and you wait. Then you get a bear breakout, pull back, and you're thinking, okay, don't want to take that trade, inside candle doji, let me wait. And look at where the market starts to accelerate up, right here. Now, if you look back, you say, hey, hang on, I could have gone in and bought above there. But would you buy above there? If this was being presented to you as the market is unfolding, you wouldn't, because you're back right at the top of the trend range. So let me use this line here. I just use that it's like a floating blue line just to indicate key levels. So at the open, let's see. Yep. So at the open of the UK markets, that's the high of the day so far, high of Asian session. You're not going to buy there. You're still not going to buy that in spite of what took place, because that's very low probability trading. Why do you want to do that when you can just, market can come and test and bounce off the high of the Asian session? So you miss this particular trade and you say, okay, if the bulls are strong, I will get a breakout above the Asian session. I'll get follow through, then I'll look to get buy a breakout, pullback I want. So buy a breakout, confirm breakout, pullback, and I want. So that I just rattled through that. So you get that bull breakout and say, okay, fantastic. There is the bull breakout candle. I need to see follow through, but I've got the high of yesterday right there. And you get dodges, sideways price action, dodges, trading range, bears, of course, trying to make everything fail. The bears that had created this high from the Asian session, trying to make it fail. And guess what happened? You don't get the confirmed breakout. You get the bears trying to fail. You get a reasonable 2-bar reversal here. Are you going to take this trade? In spite of what happened, now we can see. But chances are you're not going to take that. You're going to say, man, I can't take that. This wasn't confirmed. And, if it's not confirmed, it's a low probability trade. In any case, if I'm taking it, I have to risk size down to here. So if I risk size down to here, whatever fraction I'm trading, if it says buy 10 widgets of cable, pound versus US dollar. But look, there's hardly any opportunity there. We're talking $5.20. It's not even a quarter. So why do it? You wouldn't do it. So you wait to say, okay, if at this stage you're thinking, okay, if the bears are strong, they're trying to make this fail. They have to accelerate from here. Okay, and if I see that, I say, okay, the bears are doing what they've been doing all morning, so maybe let's see if I get a low one. But you don't get that. The bulls continue to trickle up. And now you get this interesting little setup. If we move our moving blue line just to mark the key levels, you get a breakout with that candle. Market tried to make it fail. You have a reversal. So that's pretty decent. If you had that taking place somewhere down here, you would be saying, oh, fantastic, maybe I can take a chance. But you are smack bang into a level of resistance. How many times do you look at that and you say, okay, I'm going to walk away? And the market gets there and turns. It might still give you an opportunity later on, but you do not know what's going to happen. This is a key level that the whole market is watching. And perhaps at this stage, you're thinking, this could be high, at the open, 2, 3, maybe we might get a failed breakout. Guess what we get? We get a breakout. There is a breakout candle. Now we get the follow through. You've kind of not taken all of this because as they were forming, the signals were not clear, which means they are low probability trades. Low probability trades, you really have to be careful by taking those trades. Because if you look at enough charts, this kind of structure, more often than not, the bears will come back. We may go sideways. Does not mean that if the bears are in play, that the market will sell off. We may go sideways. So you don't want to be taking that. But now we get bull breakout and follow through. And you're like, okay, finally, I'm happy with this. I've missed all of this. Bulls have confirmed they're strong. All I want to see is, number one, a pullback, breakout pullback, high one that I'm prepared to take. And if it gets to the EMA, even better. Now, some guys trade the breakout in its formation. So if you trade breakouts that way, you'd have seen that. They don't even wait for confirmation. I prefer to wait for confirmation because if you just go and sell here, you get a problem. Right? So some guys just buy here and say, I'm buying the breakout after all of this. And then they look back and say, okay, I'm going to put my stop here and hope, the market accelerates up. If you had done that, you would have been rewarded if you have held to it. But if you're waiting for confirmation, which is what I'm showing here, for higher probability trades, there is your breakout. That 1 bar candle is a good enough pullback, breakout, pullback, high one. That's where you want to get into the market. Okay, it doesn't quite get to the EMA to give you a candle. Imagine if you got a candle like this. I mean, that's a beauty. If you got that, then you can say, oh, fantastic breakout, pullback, low test of the EMA, buy. If it fails, doesn't matter, but that's higher probability. But you don't get that. Instead, it is sideways price action. We're in a doji, not we're in a doji. We are in a trading range, sideways price action. So seeing that, you might say, let me wait a little bit and see how far we get to the EMA, which would have been a wise decision, then is followed by a doji. Had you taken that, been triggered in, your stop is still here. There's nowhere else to put your stop. So you could still price it. It says, okay, you can buy 6 widgets. You can tighten your stop to here and say if it comes back into the range of yesterday, I'm not interested, I want to get out. But the proper pricing must be in place. You see a doji and you say, yes, not interested, let me wait. And then you get another breakout candle. Okay. And you say, okay, all right, I missed that. Or if you got triggered in and your stop is up there and that's moving up, I say, okay, let me wait and see if I get more confirmation and a pullback to the EMA. Instead, you don't get that. You get bear candle, high test. Bulls try to accelerate again. We get another bear candle and follow through down to the EMA. Now you say, bit of a problem. Bears are pretty strong. But if I get a decent enough entry at the EMA, I'm still happy to take it. Take an entry if I get it. And, until I get the market going above here. So that's not my stop. My stop, happy to put it somewhere down here. That's perfectly fine. But look at what you get at the EMA. You get a doji. You don't want to buy above a doji. You want to wait to get a candle like, what was that one? Like that candle or that candle, that low test candle. You don't get it. You have that bull candle. Now you got to decide, do I get in or don't I get in? Or, what's the market like to do? I see this and I see the bears. If you want to take the trade, because now you're above the EMA, above the high of yesterday, it's still above the EMA, you can take that, but you bind straight into a level of resistance. Apologies. Your stop, still the same thing, has to be down here. Then you let it go, and it's like, oh, okay, maybe you get that. At that point, now you're starting to think after that inside candle, oh my goodness, are we going to get the bears coming in to sell, but you get a 2-bar reversal to buy that, another low probability trade. Then you end up with a wedge, which is exactly where we're at. And if you look back, there's 7 opportunities, maybe 8 opportunities that if the structure had been fine, you would have jumped in. Now, what is happening? All that's happening is that there are strong forces at play in a day when there's heavy news. Yesterday, I took a little video 5 minutes before the CPI and 5 minutes after, just absolutely all over the place. Look at it and say, where would I have managed my trade? Impossible. So when you see something like this, and I probably pick the worst of the charts with unclear signals. If you see anything like this, it is best just to wait. But if it sets up neatly, like you see this candle here, if that was coming off the EMA here or EMA there or EMA here, no, you could take that trade. Anyway, the point is heavy red news, just be alert, try and stay away from unclear signals, a lot more opportunities. Thank you, guys. Guys who are in the show, coming up a little bit later on Wednesdays at the market, I will see you in the show in 15 minutes. Otherwise, Malone, thank you, sir, for managing us and hosting us. We will catch up again. Cheers, guys. Bye-bye.